Many investors and analysts are starting to believe that the financial system is looking weak and that a market correction is overdue. The Fed has responded by stating that they will continue to increase rates this year multiple times. In addition, we see repeated patterns of weakness and volatility and then a rescue by some unknown force. I wonder who could that be? You came here for the truth, so let me unveil that for you. Today we're going to look at what has happened in the stock market as of Friday's trading session. I want to connect that in with so many other economic indicators. This is a jam-packed episode. Let's begin. The federal budget deficit hit $598 billion in the first half of the 2018 fiscal year. That's according to the CBO. That is extremely large by any means, and it is predicted to go even further than that in the second half as we try to get more and more, squeeze more and more out of the taxpayer. At the same point in 2017, the deficit was $78 billion lower. That year, the entire deficit amounted to $666 billion, just 11% higher than the amount the U.S. government had to borrow in the first half of 2018. We are looking at an expansion of debt and deficits at the absolute highest level we have seen in a long time. It's not a good thing because we're being told that there is prosperity and the economy is doing well and everything, but we're not generating enough wealth for the average person or even for the government itself. They are able to generate so much in taxes, but ultimately that's just a drain on the people, and it comes around. It may not be immediate, but it will come around. Now, there's more details in here, but I really would like to get into some of the statistics that we've seen from the previous trading session, looking at the Dow Jones Industrial Average, hitting below that $24,000 mark. That is important not just for the technical indicators, trading below the 200-day moving average, but also looking at the fundamentals, looking at the psychological aspects of this as well. So let's get into a few things here, including this. I've shown you this chart before just recently, and I told you that sometimes you see this type of chart and ultimately it turns out to be a false positive. This isn't what it was cracked up to be, and you can see that clearly they're trading in lockstep here, whether we're looking at the S&P 2018, 1987, 1929, and it might just be nothing. But what happened here, this up and down pattern, was what was repeated. And I wasn't expecting that. I was expecting actually to see a continued trajectory upward. But here we are, further along, finding the same patterns. And it's starting to make me wonder, will we see that continued downward slide? We need a trigger event. That's ultimately what it comes down to. I don't think it's necessarily just going to start on its own. I think we need some sort of event to take place that's going to start it. I really don't see it just naturally happening. We'll have to see. Dow plunges more than 550 points to end the week as trade war fears rattle Wall Street. All right, so you've seen this going back and forth. It's been a little bit of an issue here. Some companies have really been slaughtered as a result. But there is really more to this. Okay, we're seeing the rhetoric, we're seeing that saber rattling that's that's really taking place right now, and we need to understand that ultimately, in the grand scheme of things, there are much bigger things that could be happening right now that should be swinging the market. But at this little concern going back and forth, I think it could be something big. But there has been 100 things in between 2009 and today that should have caused the same issue, but it's happening now. So we'll take it for what it is. Market volatility is reminiscent of the 1987 crash. Veteran trader Art Cashin says this market volatility looks like 1987. It's a good deal more volatile than almost anything else you've seen. And that's not something that should be taken lightly. Does it mean that we are going to have the same exact thing happen from 1987? No, but it is following the same trend line. We're seeing a lot of those similarities occurring, and so we need to be concerned about any particular event. Guggenheim investment chief sees a recession and a 40% plunge in stocks ahead. This is a collision course with disaster. Now, 40%, if you look at it historically, during 2008 into the bottom, March 2009, the market came down over 50%. So 50% from this point here would put the S&P 500 in a very reasonable position for people to get in and find a place to find some, let's say, a good investment, right? At 50% discounted pricing. So 50%, in my opinion, is very reasonable, very reasonable. The market has come up quite significantly just in 2017 leading up to January 2018. So just those gains there would be, something very reasonable to see disappear, because it's a short time period, and because all of that has been generated by quantitative easing, you could have people starting to take major profits from that. This wouldn't be the only one, I assure you. Many companies are starting to consider it. Anyway, what's going on with the stock market sell-off? There are many reasons for it, but what you can see as a result of all of this is that there is increased volatility, increased concern, so it's sort of a self-fulfilling prophecy. Timed to imperfection. Trade spat arrives as cycle heads towards a peak. Now, this is the Morgan Stanley DM cycle indicator, one of so many. But it's very interesting that this is now the fourth time it is in the exact same territory, and every single time this indicator has gotten to this point, the market crashed afterwards. It's truly amazing to see all of these different indicators out there, and all of them say that there is going to be a market crash. Sure, we can also use other indicators to say, no, the bull market is going to continue for a long period of time. I just didn't see a lot of these indicators coming up, let's say, a few years ago. These ones here are really starting to speak volumes. A $60 billion manager Mo selling all assets because of the trade situation that's taking place. This is a money manager at the $145 billion AMP Capital Investors. They're frustrated and saying, look, I'm going to get out of all my assets and exposures of the US. That's what we're worried about right now. That's what's the concern. And we have to think about starting to look elsewhere. I don't necessarily think that many individuals or companies or investors are going to be able to just drop the US. I think that's a little bit extreme, but they could definitely be pulling back on their investments in one particular nation, whether that is, let's say the UK, if they're worried about Brexit, for example, or looking at any other country. Full-time versus part-time jobs, March 2018. This is something I always talk about, and I'm not 100% certain exactly if these are revised jobs numbers or what, but don't even look at the actual numbers. All I'm trying to tell you here is that if we have full-time jobs lost, those can be made up by part-time jobs. This has been going on for quite a while. You've seen it. And what we can say is that there are jobs numbers that are posted out there, and you'll see 200,000 jobs added this month. So people think, wow, things are doing good. 200,000 jobs, the market is going well, and this and that. But are they full-time or are they part-time? That's what's not understood by the general public, by the mainstream media, by the financial industry. All they want to see is the numbers in the positive territory, and they have to be at least meeting or exceeding that which was expected. So if they just expected one job to be added that month and they had 2 jobs added that month, the market would be so happy and it would go up. Doesn't matter. It's all about expectations and meeting or exceeding those. Looking at the jobs, we have a major catastrophe because there are less and less and less full-time jobs being created, and more part-time jobs. That's fine. If somebody wants to work part-time, that's great. That's a great thing. But what about the people who want to be working full-time but they have to work part-time? Then you also have to factor in something else. What about the people who are working part-time so they take on 2 jobs, 3 jobs, or even more to make up for it? Well, that shows you, let's say that example, 200,000 jobs. What if that was occupied by 100,000 people? Those 100,000 people were not able to get full-time jobs, and now you have them taking on 2 jobs, skewing the numbers. And if you think it's just a small percentage of the people, that's not the way it works. You can actually see this. They've shown you the details before, that there are so many people wanting full-time, can't get it, they have to get part-time. Let me move on. All right, now, very quickly before I end off this video, you can see here, chats by ex-Deutsche Bank metals trader reveals spoofing, quote, tricks from the master. There are different individuals involved in this. I've, looked into it myself today. I was reading all about this. It goes back actually to 2017, and I probably touched on it a little bit during that time frame, but wanted to make note of it because it came back in the media. And what I wanted to just talk about very briefly was that what they do is manipulate the price of different commodities, particularly in the after hours. And there have been people out there who have talked about this before, that you can literally make a fortune just trading metals in the after hours because you know how they manipulate every single time. The individuals are able to do this. There's no oversight. There's no, let's say, restriction on what they do. Everything is legal for what they do. So it's not an issue of that whatsoever. So taking a look at this, you know that we have different assets and they are manipulated in one way or another. They can be pushed up with quantitative easing, or they can be pushed down using these different algorithms, using traders' tricks, making profit on the way down, making profit on the way up, whatever they want to do. That's all for this video. If you found it informative, please give me a thumbs up. And if you found the video informative, I know that you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. All you have to do is go to the links in the description below, and you will see the Amazon. You'll be able to flip through the books there. Take care.